In this short video, we will discuss naked short positions versus covered short positions. We will first describe and define short sales, and then touch on naked short sales and covered short sales. We will then describe why naked short sales occur within the marketplace. Short selling a stock is the process of borrowing a stock, selling the stock, with the strategy of repurchasing that stock once the market falls to a lower level. To short sell a stock, an investor needs a margin account in which they can borrow funds, which allows the investor to initiate a short position within a stock. When an investor shorts a stock, he is taking market risk without bounds. Theoretically, a stock price is bounded by zero on the downside. When you purchase a stock, the most you can lose is the total value of the stock. But a stock can rise to an infinite value, which can create significant upside volatility. When a market squeezes up, it is known as a short squeeze. Short selling is used as a strategy that anticipates a fall but exposes a seller to upside risk that can be very, very difficult. When borrowing a stock, the lender of the stock collateralizes the transaction against the stock that will be returned to it by the short seller. This standard process is called covered short selling. When investors look to short a futures contract, they do not face the same issues that are prevalent in shorting a stock. Futures contracts are derivative contracts in which the buyer has the obligation to purchase or short an asset at some time in the future. The clearinghouses that facilitate futures trading require brokers, as well as their clients, to post margin on futures contracts, which eliminate the need to borrow against a short sale. Naked short selling, or naked shorting of a stock, is the practice of short selling a stock without first borrowing the security or ensuring that the security can be borrowed, as is conventionally done in a covered short sale. When thought about logically, a trader needs to own a stock before selling that particular stock, but in some instances, this practice cannot be achieved by borrowing the stock. When a seller does not obtain the shares within a required time frame, the result is known as a fail to deliver. The transaction of that short sale will remain open until the shares are acquired by the seller or the seller's broker settles the trade. In 2008, in the midst of the financial crisis, the SEC banned what is known as naked short selling as a method of driving down share prices. Failing to deliver shares is legal under certain circumstances, and naked short selling is not necessarily illegal. The process of borrowing a stock before it is shorted is an important mechanism in the capital markets. The concept creates an artificial buyer and hampers attempts to push stocks lower if there are no lenders who are willing to lend against the stock. Naked short selling can create momentum where a stock price tumbles if an investor can rapidly short a stock without borrowing the stock first. There are reasons occasionally why naked short selling occurs. If a stock is in short supply, finding shares to borrow can be very difficult. A seller also might decide not to borrow the shares, in some cases because lenders are not available at all, or because the costs of lending are very high. If there are few lenders in the marketplace, the interest rate that a lender could charge to short a stock might be prohibitive. If a failed deliver occurs, the trade will continue to sit open, or the buyer may be credited the shares by the Depository Trust Clearing Corp until a short seller either closes out the position or borrows the shares. Naked short sales can take place in liquid markets and may not be noticed because of the number of transactions that occur or the high volume. However, if the covers are impossible to find, the trades will fail. Fail reports are published regularly by the SEC, which can draw attention to a naked short seller. When an investor repurchases a short stock, the transaction is referred to as covering the short position. Shorting a stock by investors is an important part of the daily functioning of the stock market, as it creates liquidity and transparency within the general marketplace.